New stock market highs at the US equity market have been driven by a handful of stocks. Are they enough for your own portfolio? In the last months, many equity indices, for instance in the US, have reached all-time highs. But if you look closer, this performance has been driven by a handful of very large companies, mostly US tech giants that have very large market capitalizations. If you take a closer look, which we did at the next slide, these companies, these tech behemoths in the US are already huge. Largest companies there, some $3,000 billion equity market capitalization. If you take just the 6 largest US companies, and if you calculate the aggregated value, what they are worth at the equity market currently, you come up with roughly half the yearly GDP of the US. So half the yearly economic production value in the US is equivalent to what they are currently valued at the equity market. This per se is neither good nor bad, but the question is, can such huge companies continue to grow at such a high speed, their earnings especially, that they are worth the current valuations, which are already very high after the recent rally? In this respect, we shall not forget one of the most important fundamentals of investing, to take care of a good diversification. Being invested just in a handful of companies, a handful of stocks, even if they had in the past a great performance, are great companies, have great products, etc., is no guarantee that they will continue to outperform in the future. One example in point, here you see the equity performance, the stock performance of a major US tech company. And this was a darling of the equity markets some years ago. It multiplied several times over years, but then at some point the valuations were already so high, expectations so high, people were willing to pay so much for this stock that over the next years we had no performance. Since 2020, this large tech company in the US has performed worse than an average European equity index and is actually 60% below the highs some 1.5 years ago. What do we take from this? There is no safety automatically because the company is well known, is large, is from the tech segment, maybe is doing something with artificial intelligence. You still should be broadly diversified. And you can diversify within the tech sector as well. Just do not buy only a handful of equities, I would say, but take care that you are invested in a broad sample, either of tech stocks or even in the broad market. And also pay attention that these companies too require constant monitoring if valuations are still in line with what their outlook is for the business. You can either do this monitoring yourself and this analysis, or delegate it to a fund manager, for instance, but these are 2 things you should not forget. What you should also not forget, of course, is to hit the like button, subscribe, etc., so that you do not forget our next update. Then we will look at the other extreme, which parts of the equity market currently are extremely cheap because nobody wants them, which might be a chance for the future.